Hi all, first webinar is on Once Upon a Portfolio, Lessons from Behavioral Finance. So this webinar is happening this Saturday from 10 a.m. to 11 a.m. Second webinar is on Power of Habits. So this is happening from 11 a.m. to 12 p.m. and it's an only exclusive women only webinar. Third webinar is on Navigating the Investment Challenges and Rewards of Good Investment Behavior. This webinar is happening on 11 a.m. to 12 p.m. this Saturday. The fourth webinar is on Is it a time to panic and how long will the market corrections last? So this webinar is happening from 12 p.m. to 1 p.m. All the registration links are given below. Please do register. Thanks.
Why do growth funds always falter? If you look at the equity mutual fund universe, you've seen some stellar performers over a decade, over 20 years, over 30 years. You've seen funds which have been very consistent over very long periods of time. Interestingly, during these long periods of time, there will be 1 or 2 years of underperformance and the funds generally catch up. Look at the iconic funds run by iconic managers and you will realize that you would have ripped them for 2-3 years saying that, oh, they are not doing that well for some small underperformance over the benchmark, and then in 1 or 2 years they make up and again compensate and show a clear beta over the benchmark. So what really stands out is that these individual fund managers are able to deliver sustained beta. There are enough people in our system who manage for over a decade and given sustained beta. But one thing stands out, these people have stuck largely to the value investing principles. They have looked at growth investing from the prism of value investing. So they have never lost too much money by making very significant large choices which failed. They do have failures, but the failures are not so big that it will affect the performance terminally. And that's where I believe that investors are better off trusting fund managers with a stronger grounding in value investing and those who look at growth investing from the prism of value investing. So they buy growth stocks at a reasonable value. Also, you will never see the following in the funds run by these people. You will not see front running, for example, because they are very tight in what they pay to buy a stock. They are not going to buy a stock after it went up 20% the next day, right? They might have thought of buying a stock today. If it goes up tomorrow, they are not going to blindly buy it tomorrow. They will wait. They have that discipline. So generally, you don't have front running in their funds. Second, they are not manufacturing momentum through the way they are investing. So there is no froth in those funds. What you see is more or less what you get. So in the event of they are facing a redemption or something like that, the kind of impact cost that you will see in their investing will also be reasonably controlled. It will be moderated. Now let's come to growth investing, because that's the real topic of this video. In growth investing, what I have noticed is a distinct lack of investment discipline in the process. That is a singular reason why you should be very careful in choosing managers who swear by the growth investing paradigm, because they are misinterpreting the very paradigm. Most growth investing managers buy at any price. This is another thing that I have noticed. Universally, growth investing fund managers buy at any price. Initially, they buy the best stocks at any price. So they get away. But progressively, after 4-5 years of performance, their investors expect them to come up with new winners, and that's where their troubles begin. Slowly they start going down the quality ladder, and buying at any price in a mediocre stock is a recipe for financial disaster. And when you do it by swearing and applying the momentum principle with enormous conviction, you are really setting up trouble not only for yourself but also for the unit holders. I think that in recent years, too much of this has happened in our markets, and the markets have celebrated too much of this simply because of near-term outperformance. There is no other reason. When you are seeing 4-5% more or even 6-7% more in these funds over 1-3 months, 1 month, 3 months, 6 month periods, you start diverting all your money towards those funds. So the recency bias makes people chase these funds with double vigor. And what does the fund manager do? He chases the very same stocks he has been betting on, and if it happens to be mediocre stocks, then you are in trouble, because you are inducing momentum while deploying capital, and then those stocks lose momentum because maybe the manager stops getting money or the sellers are more powerful than the buyers. In such a situation, what happens is that stock price starts going down, the performance starts unwinding, capital stops flowing into those funds, and you have the recoil or the reversal. And you all know what happens when there is a recoil effect in a portfolio. And then people start taking out money, and then impact cost comes to bite on the other side, on the sell side. All this is happening as we speak, and it will only increase in course of this calendar year. So growth investing is going to see one of its most challenging years in 2025, and growth investors are to blame for the way in which they manage their investment process. And today I can say with very high level of conviction that there is a strong case to shift your capital away from growth investors to value investors among fund managers, and it's better to be safe than sorry right now. So that's the case that I make out, and I think growth investing is going to face its most challenging year in quite a long time. 2025 is going to test growth managers for their discipline and their robustness of investment process. There is no escaping this acid test, and those who come out of this acid test stronger are definitely those who have a strong, reliable investment process and those who are disciplined even as they seek growth. So that's something that we are going to watch this year, and you can also share your perspectives on what I have just spoken, not only now but also in course of the year. Thank you for watching this video.